We suffer from knowing the numbers. This statement by Sam Zell cuts to the core of what Chapter 4 is all about, diving deep into the financial side of multifamily development and facing the reality that data, once revealed, brings both clarity and responsibility. The fourth chapter explores how to build an accurate and comprehensive pro forma, an essential financial model that forecasts a development project performance. The numbers tell a story. They reveal feasibility, risk, and potential return on investment. Without a strong pro forma, you're flying blind. With one, you gain the insight needed to make informed, strategic decisions. The chapter begins by introducing the Master Development Cost Workbook. This tool is a hub for organizing every financial aspect of your project. The workbook is divided into 3 primary sheets: development inputs, actual sheets, and quick sizing. Within the development input sheet, you'll find various tables that capture essential data like the development timeline, income and expense projections, unit mix, construction costs, land price, financing assumptions, equity structure, and even a list of commonly overlooked soft costs. The approach here is methodical and designed for accuracy. Every table plays a specific role in constructing a realistic and defensible pro forma. One of the first things you'll need to establish is your development timeline. This includes key phases like land acquisition, design, permitting, construction, lease-up, and stabilization. Getting this timeline right is critical because it drives when expenses are incurred and when income begins to flow. The timing of each phase also influences interest costs, cash needs, and investor expectations. A well-planned timeline is not just about logistics. It's about aligning your financial model with real-world constraints. Next is the income and expense table. This is where you forecast revenues and operating costs for your completed property. Income typically comes from rent, but it can also include ancillary sources such as parking, pet fees, and storage. Expenses cover property management, maintenance, utilities, insurance, and real estate taxes. The goal here is to forecast net operating income as accurately as possible. This requires benchmarking your assumptions against similar properties in the area, ideally those that are new or recently built and have similar unit counts. Unit mix is another vital element. The number of studios, 1 bedrooms, 2 bedrooms, and 3 bedrooms you include affects not just the construction cost, but also the rental income and tenant profile. For example, larger units might appeal to families and command higher rents, but they also cost more to build and require more square footage. The unit mix needs to reflect both market demand and project economics. A misalignment here can cause leasing issues or reduce your return on investment. Construction costs are one of the biggest line items in any development project. In the workbook, you'll input detailed cost categories, including site work, vertical construction, contingency reserves, general contractor fees, and soft costs like architecture and engineering. Being thorough in this section is critical. Underestimating construction costs can sink a project before it begins. Overestimating can make the deal look worse than it really is. This is where experienced third-party estimates and market benchmarks come into play. The land price section captures the acquisition cost of the property. This number isn't just a single value. It often includes closing costs, broker commissions, environmental assessments, and legal fees. These must all be considered in the overall cost basis of the land. If the site requires rezoning or has environmental challenges, those costs need to be factored in as well. Land costs are not just about what you pay at closing, but about what it takes to make the site build ready. Financing inputs include both debt and equity assumptions. What kind of loan are you taking? What's the interest rate, amortization period, and loan-to-cost ratio? Are you including construction financing only or also a permanent loan? On the equity side, you must account for how much capital you or your investors will contribute and what return expectations they have. The equity structure section of the workbook lets you model preferred returns, promote structures, and equity splits. Getting this right is crucial to understanding how profits will be distributed and how risk is shared among stakeholders. One often overlooked section is a table of commonly missed soft costs. These include items like legal fees, environmental reviews, market studies, entitlement consultants, and impact fees. Developers frequently forget these line items in early budgets, only to be caught off guard later. Including them from the start ensures your pro forma is grounded in reality. Effective rent projections are also discussed in depth. Effective rent is the amount actually collected after accounting for concessions like free rent or move-in discounts. If you're using a stabilized rent number in your model, your concession assumption should be 0%. Otherwise, you're double counting concessions. Major data providers typically offer effective rent figures, but it's essential to understand what those numbers include. Clarifying this with a data source can prevent modeling errors. To make accurate assumptions about operating expenses, it's essential to benchmark against other similar projects in the same geographic area. Costs can vary dramatically depending on location, building type, and tenant profile. For example, a property in downtown Miami will have very different expense ratios than one on the outskirts of Jacksonville. If you don't own comparable properties, you can pull data from offering memoranda or listing packages of similar properties for sale. These often include T12 financials that provide real-world operating data. An important strategy discussed in this chapter is leveraging AI tools to speed up and enhance your analysis. By entering your subject property's address into platforms like HelloData, you can generate detailed reports that include average rents per square foot, comparable properties, income and expense benchmarks, and unit-level availability. This kind of automation saves hours of manual research and provides a solid foundation for your pro forma inputs. These tools are backed by data from millions of apartment buildings, ensuring a high level of accuracy and comparability. The rent comparison graph from HelloData allows you to visualize where your property fits within the local market. Are your projected rents at the top, middle, or bottom of the range? This graphical insight can guide decisions on whether to reposition your product, adjust your finish levels, or recalibrate your rent expectations. The platform also offers Excel exports and APIs that integrate with your existing workflow, helping you maintain consistency across projects and teams. In addition to HelloData, platforms like Apartments.com allow you to manually confirm comps by searching for properties similar to yours. By looking up these comps, you can view current listings, unit sizes, rent levels, and amenities. This helps validate your assumptions and ensures your projections align with what the market is currently offering. The pro forma model used throughout the book is based on templates from breakintoseri.com, which are widely respected in the industry. These models are designed for flexibility and scenario planning. You can run multiple versions of the pro forma with different assumptions, such as rent growth rates, absorption timelines, or cost escalations, to understand how sensitive your project is to change. Another key aspect of the chapter is land valuation. Using AI to quickly analyze comparable land sales within a 1-mile radius can help you determine if the land you're evaluating is priced fairly. Prompts can be run through Claude AI to analyze land comps based on size, zoning, topography, location, and existing infrastructure. You'll want to look at sale price per square foot or per acre and adjust for differences in entitlements, utility access, and market conditions. These comps should then be reconciled into a value range, which becomes the basis for your land acquisition input in the pro forma. Verifying cap rates is also important when modeling your exit strategy. Knowing what similar properties are selling for in your market helps you determine your potential resale value. Using tools like Gemini or Meta AI, you can request recent sales of luxury multifamily properties in a specific radius and time frame. While these tools may not always provide full transaction details, they can deliver approximate cap rates that serve as benchmarks. For example, if comparable properties are trading at a 4.5% cap rate, you should consider that rate when projecting your stabilized value and exit proceeds. After gathering all this data, you'll move into underwriting. This is the process of inputting your findings into the pro forma model. But before doing so, there are a few checks to perform. Look up the site on Google Maps. Note the surrounding properties. Check for unattractive neighbors, and record distances to nearby schools, grocery stores, gyms, and other amenities. This data can be added to investor presentations and help support your rent assumptions. You can also use Google Maps to identify nearby buildings and plug their addresses into HelloData for further comps. The final step is filling out the main input sheet of your pro forma model. Only enter data into the designated input cells, typically highlighted in purple. This keeps the formulas intact and ensures accurate calculations throughout the model. Key tables such as stabilized rents, other income, and operating expenses can often be filled directly from HelloData reports. These values will then flow through the rest of the workbook, automatically updating cash flow projections, investor returns, and key metrics like IRR and equity multiple. By the end of this chapter, it becomes clear that building a pro forma is more than just entering numbers into a spreadsheet. It's about creating a living, breathing financial model that tells the story of your project, from vision to valuation. A great pro forma doesn't just project profits. It surfaces risks, highlights opportunities, and gives investors and stakeholders the confidence to move forward. Numbers, when understood and properly used, are your most powerful tool. And yes, as Sam Zell said, we suffer from knowing them, but only if we ignore what they're trying to tell us. With the right tools, the right data, and the right mindset, knowing the numbers is what ultimately leads to winning in multifamily development.